Cloud stocks are going to start reporting earnings pretty quick, with Zscaler the first out of the gate, under a little pressure. Still down about 2% after a big winning year, though. Cybersecurity has been one of the most popular trades and successful ones in this category, cloud companies. Mr. Tom White here with me in studio. Paul McCarthy joins us from Kisco Capital. Paul, welcome back to the show. Zscaler this morning down a little bit. We got Workday coming. We got Crowdstrike. How are you thinking about this group right now that is notoriously unprofitable?
Well, it's really a question of is there a secular trend towards increased cybersecurity? It's sort of AI is powering both sides. The hackers have AI, and now the cybersecurity companies are trying to integrate AI as well. And there's a concern we saw earlier this year with MGM Resorts. They, were basically blackmailed by hackers. So I think this is something that's on the mind of a lot of companies out there and able to, protect their intellectual property. So, with the sector, you really want to see is, how are they doing on a revenue basis? And is that something that they're able to capture? And, after the close today, we have Crowdstrike and Splunk as well. And we saw Zscaler. And basically the sector, when you look at, there's a lot of similarities in how they look in terms of, the technicals. They've all run up into overbought conditions into these earnings reports. So I think the Zscaler is kind of a foreshadowing of what we might see after hours with Crowdstrike, in that, they put up good numbers, but we have a pullback of sorts. So the real question is the advance that we saw this year really sustainable? Or is there going to be saturation and competition from all these companies over the next year or so that would, hurt their margins? So that's really the secular question. Is the pie expanding within the sector or not?
Like that. And because if it's not, then it becomes a little intense for these companies, right? Because the assumption was kind of always pre-COVID and then during COVID especially that the pie is going to grow forever and, growth at any cost. Suddenly we start to see a little deal activity in the group. Some of the acquisitions that we've seen, Datadog getting acquired, stuff like that may be a solution if the pie's not growing as much anymore.
Yeah, I mean, it's possible. I mean, when you look at, for example, Crowdstrike and Splunk, they both, generate free cash flow. So these aren't, companies that are having trouble, generating cash. But when you look at just from a revenue multiple basis, like Crowdstrike is at 15 times revenue. I think Zscaler is around the same. Splunk is only about 5 times. So there's definitely a lot of, potential growth priced into these stocks. And so I don't know if these, and let's point out another thing too, is that, Crowdstrike is now on Amazon's platform selling their software. Splunk partnered with Microsoft and Azure. So if we're talking about M&A activity, maybe Splunk is, being eyed by Microsoft. So that's something to be considered as well. So, it might be, an expensive buy on their part. But when you look at, Crowdstrike, I think the market cap's like 49 billion versus 25 at Splunk. So they're not cheap companies. So, if their margins, are around mid 70% gross margins. So if those margins start to get hit, then I think maybe the M&A, sort of activity starts to heat up.
Like that point. Crowdstrike this morning, taking a little bit of a hit, down more than 1% with Zscaler, but this chart's been amazing. And it seems like within this category, cyber still is the one, I guess, closest to really being a reliable profit engine. There's still big adjustments being made from the gap to the adjusted in these stocks, but is that an explanation for why they've done so much better than the rest of the sector?
There's games that companies can play, with adjusted earnings. I just focus on the free cash flow. And so, so when you look at Crowdstrike, they're running about 800 million in free cash flow, which is good to see for a growth company. So if a growth company, generally speaking, if you see growth in revenues and free cash flow generation, that means the company is planning for tomorrow. So it's something that, is obviously a noise when you look at earnings, but, you really cut to the chase when you look at the free cash flow numbers. So, but they are profitable. So, but they have to keep growing. And I think, CrowdStrike's been also looking at their expenses. Their SG&A was, over 50%. So I think they're looking to reduce their expense side as well. They're growing. So if they can execute and we get some hint of that after hours today, that would be a good sign that the companies are being managed well. And so, the question is the market valuing them properly? So, and that's, a harder question to answer.
Yeah, for sure, indeed. Okay, stick with us because I want to get your thought on Workday for a sec. But Tom, you're looking at the options for CrowdStrike and structured a mostly bullish trade here.
Yeah, you got to be wary though because we've been talking about high bar, low bar.
Yeah, high bar here.
High bar here, and that same thing on Zscaler. We've seen that little pullback here, even though it was a decent report. Option market's pricing at about a plus or minus 6.5% move, $14 either way in CrowdStrike. RSI is near that 70 level, which signals overbought on a technical basis. But if you think this one's going to go higher, this is a strategy that takes advantage of it while reducing some of your initial costs on it, as opposed to maybe just buying a straight call or a call vertical. I looked at buying an unbalanced call butterfly to the upside where I can offset some of those costs and my risk on this trade going out to the December 15th monthly option series. So about 17 days till expiration. So not a pure earnings play, giving yourself a little bit of duration in case the stock does fall. It has some time to rebound here.
Okay.
Buying the 210 call one time, selling 2 of the 220 strike calls, and then buying 1 of the 222.5 strike calls. That unbalanced call butterfly will cost you about $3.20 debit. There's your risk, $320. Everything above that break even of $213.20 over the next 2.5 weeks, it's only about 2% above the current share price.
Yeah, you're not asking
that
for much.
break even. You're not. And this is a controlled bullish trade where, hey, maybe the stock does continue to move higher. Maybe it tops out around that 220. But even above that 222.5 strike, it's more than a double on this type of trade. So controlling your costs on a bullish directional position here by offsetting it with the unbalanced portion of this butterfly.
You've been doing those trades, the unbalanced call butterflies, more to kind of hedge yourself a little bit, but then still get a very bullish-oriented trade.
Right.
All right, hold that CrowdStrike. Let's talk Workday. Paul, give me a quick thought on Workday real fast. Got about 45 seconds.
Workday is a steady Eddie. It's, a less volatile industry than the cybersecurity. So they're going to have revenues are projected to be $1.85 billion, about 15% higher year over year. But it's cloud-based enterprise software for finance, HR, planning, spend management, a little more on the boring side. But they, again, they're generating free cash flow about $1.5 billion. They trade about 10 times revenues. 62 billion market cap. So they have a lot of room to penetrate their market. They're only about a 5% penetration. So they're worldwide. So I think that, we'll look to see if they can deepen that penetration in the call today.
Nice. Great stuff. Paul, thank you very much. Tom, Workday just below the 52-week high. Not quite.